Welcome back to Chapter 8 in Intermediate Accounting. In this chapter, we're talking about inventories and we're going to talk about the different methods. But first, let's look at what really counts as the physical count of inventory, because every company, whether they're using perpetual or periodic inventory, needs to do a physical count of what they have in inventory at least once a year. And that's because there could be things like theft, or there could be things that have been damaged. They need to go through and count those at least once a year. So what all does that physical count of inventory include? So first of all, we have items in possession of the company. So they have their maybe warehouse or their back room that has the inventory in it. Also the things that are on display for customers to purchase. Those would all count as inventory, of course. Then we also have goods in transit, and we are going to dig into each of these things that I'm going to talk about here further in just a minute. So goods in transit, goods on consignment have to be considered in inventory, and anticipated sales returns. So that's going to be our focus in this video, is to talk about each of those to start out with. So goods in transit, those are items that are currently being transported and have not yet reached their final destination. So those goods that are going from the supplier to the company that purchased them, as they're in transit, who owns those goods? So it is all based on which type of method the companies have agreed upon. But goods in transit, they're in the process of being transported. So from the supplier to the company, there's a little error there, my word company, or between the company to the customer. And then when it comes to tracking, they have to figure out what flows best, and it's all based on the shipping terms. So let's look at what those shipping terms are. So we're using all these galactic things because of our company that we're going to be working with, Galactic Gadgets. So that's why we have all of these outer space images here. So our shipping methods are either FOB. FOB stands for freight on board. So you've got your goods that are freight and they are on board. They're in the truck or in the plane or whatever, being moved from one place to the next. So freight on board, shipping point, or freight on board destination. That's our two options. And this is going to tell us whether or not that inventory that's in transit will be on our books, or they'll still be on the books of the suppliers until they get to us. So FOB shipping point, the ownership of the goods transfers to the buyer when the seller ships the goods. So you've got, let's say, it is a U.S. Foods distribution center, and they are shipping the foods to Subway sandwiches. As soon as it leaves U.S. Foods, if it's FOB shipping point, soon as it leaves, it is now in Subway's ownership. So that is FOB shipping point. So while it's in transit, Subway would be the ones to show it in their inventory. The buyer, so Subway, includes the goods in their inventory once they leave the seller's location. So it's going to show up on Subway's inventory as soon as it leaves US Foods. And we're going to talk about how that affects the cost of anything in transit. So if it's FOB destination, it's opposite. The ownership of the goods transfers to the buyer when it arrives. So while it's traveling from US Foods to Subway, it is going to still be ownership of US Foods. It's not Subway's ownership until it arrives at Subway. So the seller does not show it in their financial statements as their ownership and inventory until it arrives there at their location. So let's look at an example with Galactic Gadgets. They ordered a shipment of laser keyboards from a supplier on June 28th. The goods were shipped on that same day. The terms were FOB shipping point. The shipment was still in transit on June 30th, which was Galactic Gadgets' accounting period, their end of their accounting period. So the question's going to be, should the laser keyboards be included in Galactic Gadgets' inventory on June 30th? I'm going to give you a second to think about that. It's FOB shipping point. It shipped on June 28th, but as of June 30th, it's still in transit. They have not received it yet. So should Galactic Gadgets include that in their inventory? Since it's FOB shipping point, it transferred to Galactic Gadgets the day that it shipped. They will include the laser keyboards in their inventory because it's FOB shipping point. So as of June 28th, Galactic Gadgets will start showing it as their inventory. So really important to understand the difference between shipping point and destination for questions like this. So let's jump to goods on consignment before we get any more into that. So you've probably been to a consignment shop before, and you know that this is where different sellers, whether it's individuals or it's companies, are going to bring something to the store. The person that's selling it is going to still have the ownership, but they're just displaying it at the consignment shop. So let's look at this example here. The owner of the goods are the consignor. That's what they're called, the consignor. The consignee is the store that's displaying it, saying, hey, come buy this artwork, come buy this furniture, or these clothes. So if a buyer is not found, the goods are returned to the owner. Either way, as long as they have not sold, the consignor, the owner, is going to keep legal title. If a buyer is found, the consignee keeps the commission and then sends the proceeds to the consignor. So let's say it was called Sally's Consignment Shop, and we are beautiful bows. We take our beautiful bows, we put them in Sally's Consignment Shop. Sally's never actually shows them on her inventory. We keep them in our inventory at Beautiful Bows until it sells. Once those bows sell, Sally's going to keep a portion of it and show it as revenue, and then she will send us at Beautiful Bows the proceeds. So whatever is left over for us. So we would have had an agreement. Maybe she keeps 30%, we get 70%. So the bows stay on Beautiful Bows inventory until it is sold. And maybe Sally said, well, after 30 days, if you haven't sold at least 10 bows, then I'm going to send these back to you because clearly they're not that desired. So you'd have some kind of agreement like that. So the goods held on consignment are included in the inventory for the consignor until they are sold by the consignee. Sale is recorded by the consignor only when the goods are sold. The consignee, the title passes to a third party, whoever actually bought it. So the consignee, whoever owns the consignment shop, never shows it in their inventory. It stays on the consignor's balance sheet as inventory until they sell it, and then it's going to move off to cost of goods sold. All right, then we have sales returns, which we've already talked about some in a prior chapter, but let's jump back into that, talking about inventory. When the customers return merchandise, which we do that all the time. I have something I need to return to Amazon today, and I returned 5 things to Amazon yesterday. It feels good. It's like, oh, I made money. I didn't make money. No, I just didn't spend as much. The important thing is to not convince yourself that when you return something, now you have free money to spend, because no, take that money back, put it back in your account, get a refund on your credit card. All right, that's a whole nother thing. So when the customer returns the merchandise, the cost of goods sold is reduced. So we're going to show that. We're going to decrease the cost of goods sold. We're going to put it back in inventory, and that's assuming they returned it and we can resell it. It's not like it was broken and they returned it, but as long as it's something we can resell, then we put it back in inventory. The sales revenue and accounts receivable are also reduced. So the same adjustment is made at the end of the period to account for estimated sales returns. So we talked about this in the last chapter, how we estimate how much will be returned, and we can base it off of different methods there. So when it comes to net purchases, the cost of inventory include necessary expenditures to acquire the inventory and to bring it to its desired condition and location. So when you order, let's say some, a truck full of computers, then you have to pay not only for the computers, but any shipping costs that you had to pay. Now that means it was FOB shipping point if you had to pay for the shipping costs. The shipping costs are included in inventory. If you had to have insurance on that whole truckload of computers in case something were to happen to it, then that insurance would be included. If there was any any setup or anything like that that they had to do, that would be included as well. So all of the cost of getting the inventory to you and ready to sell gets to be included in that asset of inventory. So in order to get to our net purchases number, we have our total purchase amount. How much did it cost to buy those computers? Plus freight and any other cost, insurance, anything like that. And of course, we subtract out any returns or discounts that we get to take advantage of as well. So that brings us to our net purchases. So freight in on purchases. So in perpetual inventory, freight costs are added to the inventory account right when we have to pay for those. In periodic, freight costs are added to a temporary account. Remember, we already had that temporary account for purchases throughout the accounting period. But now we have a temporary account that would either be called freight in or transportation in. Either way is fine. And later it gets added to the purchases. Shipping charges when we are shipping them to our customers are not included in inventory. They are treated as an expense or part of cost of goods sold. So typically on an income statement, if we have to pay to ship out the goods to the customers, you will see a shipping expense line item under our operating expenses. So any cost of us sending it to the customer, that's not included in inventory. We didn't have to pay for that in order to have that inventory ready to sell. But if we have to pay for it to send to the customers, separate expense, not included in inventory. So remember that if we have to pay to get the goods to us, we include it in inventory. If we pay to send them to the customer, then we put that in an expense, or we could wrap it in cost of goods sold. Then our purchase returns, we would return an item to the supplier that supplied us the goods. When we return those, it reduces the cost of our purchases or reduces either cash. We're either going to have cash come in for that return, or if we haven't paid for it yet, it will reduce our accounts payable. So for perpetual inventory, if we return some goods, we are going to credit inventory because we have less goods now. And we debit either accounts payable because we owe them less, or cash if we already paid for it. In the periodic inventory system, we would credit purchase returns and allowances, which is a contra purchases account. And then we debit, again, either accounts payable or cash. So there's no direct change to the inventory account if you're using periodic, but there is if you're using perpetual. All right, lots of little things here and there that we have to keep in mind. So make sure you're taking note of those and reviewing them because you don't want to forget each of these things. Let's talk about purchase discount. So we know that we can offer customers a discount to try to get them to pay sooner, and perhaps our supplier will offer us a discount to get us to pay sooner. And if we take advantage of that, then we can get a discount on our invoice. Some offer that, not all of them will. So Galactic Gadgets buys $5,000 worth of inventory on July 1st. Terms are 210 net 30. So they get a 2% discount if they pay in 10 days. Otherwise, they pay all of it in 30 days. They pay on July 8th. Perfect. It's within the 10 days, so they're going to get a 2% discount. So before we think about the discount, if we were using perpetual inventory and we're using the gross method, we would have shown our July 1st purchase as an increase to inventory. We got our inventory, and we would show a credit to accounts payable. We know it's not cash because they clearly haven't paid yet because they have credit terms. And then on July 8th, they would show our accounts payable. It would be paid in full. We got to get rid of the whole thing by debiting accounts payable for $5,000. Then we are going to credit cash for just 98% of it because we get a discount for paying early. So we're going to take 98% of the $5,000, which is $4,900, and we send them the cash. The other 2%, the discount, we take out of inventory. Now, this can be tricky because a lot of students will say, but we're not giving any inventory away. But remember, our inventory number is not the number of items we have. It is the amount of money we spent on the items. So we didn't spend $5,000 on it. We don't want to show inventory at $5,000 because now we only spent $4,900 on it. So we need to decrease inventory so that it will reflect the true cost of our inventory, not the number of items in inventory, but the amount we actually paid for it. So let's look at Galactic Gadgets. If they purchase high-tech gadgets from an intergalactic supplier and sells them to retailers across the galaxy. The company began the year with inventory of 150,000. And then during the year, they have additional transactions. Whoop, we got a little movement on the UFO. They purchase 700,000 of inventory throughout the year with terms 210 net 30. Freight charges were $18,000, so they had to pay it. Inventory with a cost of $25,000 was returned to the supplier for credit. All purchases on the account were paid within the discount period. Sales on account totaled $940,000. The cost of gadgets sold was $600,000. Ending inventory at year-end totaled $200,000. What I would recommend at this point is for you to pause it and to, try to figure out what the journal entries would be throughout the year for all of this going on. It's a lot, but we're going to see inventory increasing. We see some inventory decreasing. We see accounts payable going up and down, cash increasing and decreasing. We're going to see revenue. We're going to see our cost of goods sold affected. So could you stop and try to make all of the journal entries that relate to this? That I think that is the best way to do it, because that way, whenever I show you, you can see how well you're understanding it. So let me give you a minute to try to do that. All right, are you ready to see the answers, to walk through these journal entries together? So I'm actually going to show it to you with perpetual and periodic system. So if you want to pause before you actually look at the answers and do it both ways, you're welcome to do that. So we started out with increasing our inventory throughout the year of 700,000. Now, of course, that wasn't all done at once, but we're going to look at what the increase and decrease of each account would be throughout the total year, even though it would have been separate entries. We're just going to see this in thousands, so I dropped off 3 of the zeros. With perpetual, we increased inventory and we increased our accounts payable. With the periodic system, we increased purchases, and again, we increased the accounts payable for the amount that we purchased. Then we see that we have cash that we had to pay out for freight charges. So under the perpetual inventory system, we're just going to increase inventory because that was a part of the cost of inventory. So we increased that by the $18,000 and we paid them cash. For periodic, remember, we're going to have that separate account, the freight in account, for $18,000, and then we paid out cash. So we're keeping purchases and freight in separate under the periodic system. Then whenever it came to returning some of the goods, they returned $25,000 worth of the goods. We are going to get rid of some of the accounts payable. They haven't paid for it yet, so we're going to go ahead and decrease accounts payable in both situations by $25,000. And then under the perpetual, we are going to decrease the inventory. We have less inventory. We spent less on the inventory. And then for the periodic, we have a separate contra account called purchase returns that we are going to record the $25,000 under. Then whenever they actually paid for the inventory that they still have, they still have $675,000 worth of inventory. They started with 700, they returned 25. So they're going to be paying 98% of the inventory cost. And so we're going to get rid of the whole accounts payable that's left with the 675 in both situations. we are going to show in perpetual a decrease for that 2%. Remember, it was 210 net 30, so they got a 2% discount for paying within the credit terms, as it told us that they did. And we decrease inventory for that amount under perpetual, and then we pay the rest in cash. Under periodic, we are going to show purchase discounts. We're going to show that contra account for the 2%, and then of course pay the rest in cash. So you see how these differ, but at the end we're going to end up at the same amount in cost of goods sold and inventory. So now let's look at our next example, our next entries. So they sold $940,000 worth in revenue. So in both situations, we have the same entry. We're going to debit accounts receivable. It told us they did it on credit terms, and we're going to credit sales return. This is not for the amount we paid. This is the amount that the customers paid us. Then in perpetual, we're going to show the cost of goods sold that they told us. So we're going to be debiting cost of goods sold, which is an expense account, and we are going to credit inventory. For the periodic system, they don't do anything throughout the year with cost of goods sold. Remember, we're going to do all of that at the end, and we talked about that in the first video for this chapter. So then at the very end of the period, perpetual system, everything is caught up. We don't need to do anything else. But under periodic system, we now need to show that we are going to calculate what the cost of goods sold was. We take the ending inventory amount, which was given to us, of $200,000. We are going to get rid of the purchase returns and purchase discounts. We're going to get rid of the beginning inventory, the purchases, and the freight in. And when we take the debits minus the credits, it tells us how much our cost of goods sold will be. So I went through that part fast, but again, if you look back at the video before this, at the end of the video, we calculated this. So if you need a little bit more of a refresher, then I would go for that. But this makes it to where perpetual and periodic are going to end the same with how much is in inventory and how much is in cost of goods sold. They just did a different approach at that. All right, so in the next video, we will start talking about the inventory cost flow. I'm not going to jump into it yet. There's going to be a lot to go into that. So this is a glimpse of what's coming up. But just make sure you watch video number 3 to start looking at the cost flow.